Environmental Management, BUSA 531, The Economic Crisis of 2007. Bernanke's Global Savings Glut. Cohort A, Team 1. Members include Wayne Butler, James Grieve, Melanie Lucia, Mark Moreau, and Greg Smith. Global Savings Glut is a term coined by Ben Bernanke in 2005. The term describes a situation in which there are worldwide too many savings with respect to investment opportunities. On a national level, a savings glut creates the tendency for savings to finance current account deficits instead of investments. This can be observed, according to Bernanke in 2005, in developing and industrial countries. The most important receiving country of these export surpluses, financed by excess saving, is the United States, which runs a current account deficit. Bernanke went on to say that these increased capital inflows to the United States were from emerging markets in Asia and commodity exporters to other parts of the world, purchasing U.S.-backed assets and securities instead of investing in their own economies. Further, in response to the global savings glut, the trade deficit increased, interest rates were kept low, demand for capital and residential investment rose, and the incentive to save decreased in the United States. Bernanke further argued that because of the trade deficit was not made in the USA, policy steps to reduce the budget deficit or to raise private savings were unlikely to significantly reduce any trade deficit until the global savings glut ended. Bernanke's global savings glut view and the conventional view amongst economists is desperate. Our discussion points for today will include the current state, domestic considerations, global consideration, impact on America, China and Asia, and some observations. Let's explore some more of these issues. The global savings glut led to the increase in the current U.S. deficit and relatively low and long-term interest rates. Increased capital inflow to the United States were from emerging markets in Asia and commodity exporters in other parts of the world, purchasing U.S.-backed assets and securities instead of investing in their own economies. These investments included U.S. Treasuries, agency debt, and agency-sponsored mortgage-backed securities. The surge in investment in these safe assets created a major problem both domestically and globally. There were two major considerations on the domestic front. First, the yields on these investments were reduced, thereby making money cheaper and debt more accessible. And second, it provided incentives for the U.S. to develop investment products featuring risky loans masked as highly rated securities. Lower long-term interests and mortgage rates fueled more demand in the housing market and an increase in housing prices. The result of these factors was a house of stone built on a bed of sand, an unsustainable housing boom, financed by risky subprime and variable rate loans granted to Americans, in many cases that were incapable of servicing this debt in the long term. Globally, the problems are fivefold. First, financial crisis in the developing world in the late 1990s in Mexico, Turkey, Argentina, and Southeast Asia reduced these countries' ability to borrow funds, resulting in the flow of capital to developing countries being redirected to a stable destination, America. Within these developed countries, economic policy shifted to saving to lower deficits and to accumulation of stable foreign exchange reserves. Secondly, the demographics of industrialized nations are changing. Dramatic increases in the ratio of retirees to workers in industrialized nations resulted in higher savings, transitioning these countries from being net borrowers to net lenders in capital markets. Thirdly, there is a significant trade imbalance between the U.S. and the rest of the world. In 2004, the U.S. imported $1.7 trillion worth of goods and services, while only exporting $1.1 trillion. The U.S. receipts from the sale of these exports are insufficient to cover the cost of imports, causing Americans to borrow the difference on international markets. The fourth point is that emerging economies are not investing in new capital goods, such as construction of factories, residential developments, and infrastructures equivalent to their own manufacturing growth. enabling them to save more than they are investing. And this difference in savings can be lent on international markets. The fifth and final and very important point is that the emerging market economies in oil-rich regions of North Africa and the Middle East became beneficiaries of high oil prices and became net lenders rather than net borrowers in international capital markets. The U.S., with low interest rates and very low savings rates and insatiable demand for housing and goods and services, have turned to foreign borrowing to finance domestic investments. America's investment in new technology and increased productivity, coupled with the nation's reputation of stability, low political risk, strong property rights, and a good regulatory environment, made the U.S. an attractive destination for foreign investment. The result was rapid capital investment in the U.S., sparking appreciation in stock prices, stimulating a boost in the value of the dollar, lowering interest and mortgage rates, and creating a record level of home construction and igniting a frenzy of increased housing prices. The lure of cheap money, an ascending stock market, the speculative prospects of rising property values, and an overall economic prosperity created by a mirage of stability that motivated Americans to spend more than they were willing to save, resulting in an unsustainable and inevitable collapse. There are three key factors emanating from China and Asia that contributed to the global savings glut: the Asian financial crisis, China's accumulation of war chests of foreign reserves, and Chinese fixed monetary policy. According to Bernanke, in 1997, Asian financial crisis and the subsequent reduction in investment in Asia was the genesis of the global savings glut. Bernanke also believed that developing countries' governments borrowed to avoid necessary fiscal consolidation, and that the poorly governed nations failed to properly allocate funds to capital investment projects. Combined, these items led to a lower level of confidence, thus shifting the world capital markets to invest in America. Chinese, sensing future crisis, built up war chests of foreign reserves as a strategy to protect against potential outflows of capital, and intervened with foreign exchange policies, including fixed monetary policy that prevented exchange rates appreciation to promote export-led growth. China and other East Asian countries also depressed capital investment, leading to a boost in domestic savings, and used these funds to purchase foreign assets, most notably U.S. treasuries, including treasury bills and mortgage-backed securities. In effect, these countries acted as financial intermediaries and channeled domestic savings away from local uses and into international capital markets. As America's economy boomed and its residents became reliant on credit instruments to fuel their desire for housing and goods, China and East Asian countries saved, creating a saving disparity that resulted in China and its neighbors becoming net lenders to the U.S., becoming a net borrower of capital. China's fixed monetary policy is based on the pegging of the yuan to the U.S. dollar. During the savings glut, China accumulated more dollars, U.S. dollars, and assets-backed securities to increase its trade surplus, causing its currency to appreciate less and make their exports more affordable for U.S. consumers, thus perpetuating a trade imbalance between the two nations. As interest rates fell and consumer confidence grew in the U.S., more Americans were overspending on cheap imported goods bought on credit, contributing to the inevitable and pending collapse of their economy. Bernanke's global view and the conventionalist view, although phrased differently, say essentially the same thing. The conventionalists view that the U.S. is saving too low relative to its foreign savings, and the global savings glut view emphasizes that foreign saving is too high relative to the U.S. saving. The conventionalist view focuses on a cause of the low level of U.S. saving relative to the rest of the world, while the global savings glut views focuses on causes of the high level of world savings relative to the U.S. Although neither view leads to any hard conclusions about whether trade deficit is good or bad, Bernanke does propose that the responsibility for reducing the deficit lies squarely on the backs of the foreigners. As interest rates fell and consumer confidence grew in the U.S., more Americans were overspending on cheap imported goods, bought on credit, contributing to the inevitable and pending collapse of their economy. Ultimately, the responsibility should be spread amongst the lenders, the borrowers, and the users of credit. the lure of hot money, or the rapid inflow of capital created instability in the markets, and the aftershock will be felt for years to come.